Welcome to On the Ballot with Ballotpedia, where we connect people to politics by providing neutral, nonpartisan, and reliable information on our government, how it works, and where it's headed.
Hello, everyone, and welcome back to another episode of On the Ballot. I'm Norm Leahy, your host. I'm a senior editor at Ballotpedia. And one of the things that Ballotpedia tries to do is to provide a broad overview of the agencies and people that make government work. One of the more important agencies that is part of the government and is in the news a lot, especially recently, is the Federal Reserve. And we are really honored today to have Jeffrey Lacker with us, a senior affiliated scholar at the Mercatus Center at George Mason University in Northern Virginia, and the former president of the Federal Reserve Bank of Richmond, where I'm here today. Jeff, it's good to have you with us today.
Great to be with you, Norm.
And we're going to be talking, I'm not going to ask you to talk about the direction of interest rates or any of that nonsense, because who knows. But the Federal Reserve is a thing. And some people think of it as sort of a black box, and that the head of the Federal Reserve is sort of like the great and powerful Oz who manipulates things. Mm-hmm. But you've been in it. You've been in that arena. Where did the Federal Reserve come from? What great problem in America was it designed to solve, and how is it doing at that?
That's a fascinating question. The Fed was founded with legislation that passed in December of 1913. Before that, there were central banks in the U.S. before the Civil War, but nothing after that until the Fed. It was designed to solve essentially two problems related to monetary control, the control of the monetary system. At the time before the Fed, the money supply consisted of the paper notes people had used hand to hand and deposits at banks. And the notes were issued by national banks, nationally chartered banks, under a system that was a bit cumbersome and a bit complicated. They had to keep collateral with the Treasury. And the problem it led to is that at times when people would lose confidence in a couple of banks, they'd try and pull their money out. And in a particular region or maybe nationally, there was a scramble for those notes. It was really hard to expand the supply of those notes rapidly and in order to satisfy that demand. And that led to some stringency. There were some workarounds that involved the large clearinghouses issuing things that were of dubious legality, but that served as substitutes for paper notes. They were called certificates. Clearinghouse certificates. But that process was managed by the clearinghouses. And those were, large city banks. I think J.P. Morgan in New York was the big mover and shaker behind the New York clearinghouse. And so the second problem that the Fed was meant to kind of address was the governance of how monetary affairs were managed at times where it was really important, like these crises. And out in the country, people kind of didn't like the idea of big New York City banks and J.P. Morgan in particular managing it. So they wanted a more democratic governance over monetary management. And that led to the establishment of 12 Federal Reserve banks distributed around the country and an agency in Washington called the Board of Governors of the Federal Reserve System that was designed to oversee the 12 banks. And that's how we got the Federal Reserve System we know today.
And when you mention, just as a side note, when you mention J.P. Morgan, you're actually talking about the honest to goodness, real J.P. Morgan.
Yes,
the person.
Indeed.
Yes.
And there was this crisis. There was ferment brewing in like the 1880s, 1890s, especially about sort of reforming the monetary system. People saw these problems with it. There were sort of these technical issues, and they wanted to, have a monetary system that was more flexible. But then the crisis of 1907 really galvanized the political system to do something about it. And in that crisis, J.P. Morgan was actually down here at a Baptist church convention when the crisis broke in October, and he slipped away in order to avoid rousing suspicion, went back to New York and called the leaders of the financial system together and basically locked them in a room and made them cough up money to solve the problem.
Isn't that fascinating? Yeah, it's amazing how far we've come, or have we? But the thing is, the Federal Reserve is so it has a unique structure in that there's regional control with local boards that select. When you were Fed president, for example, it was the regional board
Mhm.
that chose you, correct?
That's right. Yeah. So each reserve bank, the reserve banks are modeled after these clearinghouses, and they're membership organizations run by the banks that sort of create and own the clearinghouse. And so the reserve banks are owned by the member banks in their district. And the idea was these are universal membership clearinghouses that all the country banks can join. Up until then, the country banks weren't in clearinghouses and didn't really have a voice in the monetary system. So that governance structure was very much part of that vision of democratizing the leadership and governance of the Fed. Now, since then, in 1935, there was a reform of the Federal Reserve Act that centralized power a little more clearly in Washington and created what's called the Federal Open Market Committee. So at the very beginning, it was thought that the control of the money supply would occur via reserve banks lending to member banks. But in the 20s, they rapidly discovered that reserve bank purchases of US Treasury securities were just as good, in fact, better at managing the money supply and monetary conditions. And so they also discovered that when one bank buys and the other bank sells, it sort of cancel each other out. So they needed to coordinate these operations because they all took place in Chicago and New York and the like. So they formed this open market committee and delegated to the New York bank the job of buying and selling treasury securities, and the ownership is split up among the reserve banks. Um, and so
And
that's how the current structure of monetary policy being conducted by this committee came about.
and over time, over the what 110 plus years of the Federal Reserve's history, its role has changed, just like you alluded to. Its
That's right.
structure, its governance changed. What are some of the major events that have brought those changes about?
Yeah. So, I mentioned the shift from lending to commercial banks to operating in U.S. government securities. So lending became a very small role. In the 1930s, the Fed utterly failed to manage its responsibility to manage the money supply. It allowed the money supply to collapse by 30%, which, if you think about money chasing goods, led to a 30% fall in the price level. That's to say, -9 or 10% inflation a year for 3 straight years, which was devastating. People who owed money in dollars, took out mortgages, were unable to pay them back, led to widespread bank failures and distress. And that failure led to those reforms I talked about. In World War II, the Fed was asked to peg the interest rate on US government securities that the Treasury was issuing to finance the US war effort in World War II, a gigantic increase in expenditures. And they pegged the yield on those bonds, which required that they buy a lot of them, which increased the money supply and would have caused inflation if it wasn't for the price controls and rationing system that the federal government put in place. After the war, the Fed wanted to get out from under that obligation to peg interest rates because it had responsibility for monetary conditions, and without the ability to let treasury rates rise when it was warranted, they were sort of hamstrung. They got into this conflict after the Korea War broke out. This issue came to a head. They got into a conflict with Harry Truman. So the war breaks out. There's widespread speculation there's going to be another defense buildup. Commodity prices rise, inflation is rising, and the Fed wants to raise rates, but it wants to let Treasury security rates rise. And the president at the time, Harry Truman, is a small businessman from out in the Midwest. He likes lower interest rates, like a lot of small businessmen do. And he and his Treasury secretary were pressuring the Fed to, maintain this peg. Well, this amazing story. Truman tried to intimidate the Fed. He called the entire Federal Open Market Committee to the White House for a meeting one evening, and he lectured them about the need for maintaining this price, this ceiling on Treasury yields. The Fed members just sat on their hands, went back to the office, and one of them wrote a memo to Files. A guy named Mariner Eccles, who had been an advisor of Roosevelt, had been chair of the Federal Reserve previous to Truman, and wrote a memo to Files saying, well, here's what Truman said, here's what we said, which was nothing. Put it in the Files. The next morning, Truman calls in reporters and he lies about the meeting. He claims that the Fed had agreed with his request that they keep pegging rates. Well, Eccles goes and leaks this to the Washington Post and the New York Times, leaks the memo, and Truman's disgraced, has to sue for peace. And he sends they negotiate. He sends Treasury representatives to the Fed to negotiate. And what they negotiate is called the Accord, the Treasury-Fed Accord of 1951. And it was an agreement that the Treasury would let the Fed let markets determine interest rates, and the Fed had its own his independent control of its balance sheet. It gave the Fed the ability to control monetary conditions by managing its balance sheet the way it wanted. And that was really a cornerstone of the Fed's independence. But it was basically a document just acknowledging politically, an understanding between the two institutions.
So what you've described there, though, is something that people will somewhat recognize today, that there are times when the White House and the Federal Reserve are at loggerheads, and it can burst into the open in unexpected ways. You gave the example of the Truman administration. There was stuff during the Johnson administration, the Nixon administration, even Reagan had his problems with the Federal Reserve Board. How have those things worked out generally?
Yeah, that's a great question. So it's it's not in statute or in hard law that you can't pressure the Fed. It's just a political norm. The fact of the matter is that the Fed's structure could be altered by Congress, at their pleasure. Mm-hmm. And so the Congress and the political system has always had the ability to threaten changes to the charter of the Federal Reserve System in ways the Federal Reserve System wouldn't like and would disapprove of. It always has the option of threatening that in order to get what it wants. And that's happened. History is replete with that. If the Fed lowers interest rates, it's going to provide a short-term stimulus to economic activity, but at the cost of longer run accelerating inflation as demand rises more rapidly than supply, and inflation pressures emerge. And that's the balance the Fed has to strike. Politicians tend to have a short time horizon. They tend to think in terms of the next election. That came up in under Johnson. He wanted to finance the Vietnam War. He didn't want Congress to take away his Great Society program, so he wanted to downplay the inflationary pressures, but he also wanted to keep interest rates low. If interest rates rose, Congress would point to that and say, well, look, we gotta cut back on Great Society programs in order to finance Vietnam. So that really put Johnson in a bind, and he was really abusive. I mean, I don't know if you want to hear this story, but there's this famous, the Fed chair at the time in 1965 had raised the discount rate. Johnson immediately called him to the Western White House, his ranch in Texas, and berated him. Said, "You've run a rapier through me," and he took him on this famous ride in his white Cadillac convertible. He was fond of taking visitors on these rides across these bumpy ranch roads, and you can see this picture of Johnson in the driver's seat. And the Treasury Secretary flanking this guy. Remember those old bench seats in those old cars from the 60s? Right. You could sit three across in the front, and Martin's sitting in the middle, and he's looking distinctly uncomfortable. So that was a great example in the 60s. And sure enough, interest rates were were inhibited. Martin never increased interest rates enough, inflation went from around 1.5% in the mid 60s to 5% at the end of the 60s. Then Burns comes in, famous story. Nixon imposed upon him to cut interest rates in 71 in order to aid his reelection in 72. Nixon had gone off the gold standard, which is very important because that means that the only thing monitoring and controlling inflation isn't gold. There's like no one else but the central bank to limit the money supply. Central banks worldwide, when we went off gold, were thrown to their own devices. It's like, okay, you guys are in charge of monetary stability in a way they hadn't been before that. And at the time, Nixon imposed wage and price controls to prevent inflation, to keep inflation low. Those succeeded in bringing inflation down in 72. The monetary stimulus of cutting rates succeeded in lowering the unemployment rate. In 73, wage and price controls come off, inflation takes off, just goes through the roof, and we're off to the races with high and volatile inflation. The Fed never really being able to feeling able politically to take enough action to get inflation back down until Jimmy Carter, to his great and abiding credit, appoints Paul Volcker, who had warned him in the interview, I'm going to take very strong action to counteract inflation. This is in 1979. Volcker is convinced, he goes back to New York, convinced he didn't get the job. Carter decides to appoint him, but tells his advisors, this will probably cost me the election in 1980. Sure enough, he lost the election in 1980. But Volcker took really strong action in 80, 81, 82 to bring inflation down. And it was clearly a matter of establishing credibility, establishing the Fed's reputation, convincing the American public that they're going to bring inflation down. So don't keep raising your prices as if they're going to tolerate it. So that worked. He brought inflation down to around 4% in the mid 80s. But then and Reagan supported him at first, despite his advisors' opposition. Later in the Reagan tenure, his advisors had a little more clout and exercised a little more, put a little more pressure on the Fed. Volcker felt he had to resign 87, and Greenspan came in. Greenspan was afforded a fair amount of deference, especially by Bill Clinton. And Clinton and his administration deserve a lot of credit for understanding that it's in their best interest longer term to keep inflation low and stable. That's the way to keep interest rates down. And so this I was sort of the high watermark of political deference to the Fed's judgment.
Yes, and that seems like such a lifetime ago now, doesn't it?
It does, indeed.
But here we are, and I know we could talk about individual things that even happened in this century. I still haven't gotten used to saying that, but it's right now. Tell me if this is what you think about this. We're sort of at another one of those points where the Federal Reserve's role and its independence are under scrutiny, under debate. Mm-hmm. I'm going to ask you to do something dangerous in politics in general, and that's prognosticate. But do you think that big changes are on the horizon, or do you think that we might get more of the same, but with changes at the margins?
I think personnel is really important here. I think who gets appointed as the chair of the Fed is important, and other members of the Board of Governors, this agency in Washington that has a lot of influence within the system. Of course, the appointments at the Federal Reserve banks are important as well, but there tends to be stability there, people there 5-10 years in those positions. I think that, serious structural change would require an act of Congress, but I think that the Fed has a tremendous amount of discretion in a lot of ways. So I've described the Fed as an institution whose primary role is monetary conditions. And for doing that, what's essential is their liabilities, the monetary instruments that they provide to the economy. There's paper currency, notable people at least used to carry around in their pocket. A lot of people don't anymore. but also bank reserves, the deposits banks hold with the Federal Reserve System. That's the money supply, and the terms on which they offer that to banks are what determine monetary conditions. So the Federal Reserves are banks. They've got liabilities, they've got assets. The important thing for monetary policy is their liabilities. On the asset side, they could do everything they do for monetary policy, holding only U.S. Treasury securities. Instead, the Fed has had this facility to lend at what's called the discount window to commercial banks. And it used to be a really minor thing. But in the great financial crisis, it used that authority to lend, its lending authority, to make some very massive in, uh, interventions in credit markets. And they did that again in 2020 in the pandemic, bolstering certain asset prices, trying to channel credit to certain sectors and the like. And that huge and discretionary exercise of authority, is kind of unrelated to monetary policy. They didn't need to do that to control interest rates and keep interest rates down. So they've sort of brought on themselves the perception politically that that they have a lot of authority, a lot of discretionary authority, and so they've left themselves vulnerable to attack on that score, I think. And so, it doesn't look like the political backlash they're getting now is related to those credit market interventions, but it's what I think has contributed to the perception that they're a very large, very powerful institution with the capability of doing a lot of things that are economically important for people. And their accountability is, shall we say, muted. So the accountability, so it's set up by Congress. This is, the authority over money is Congress's, and Congress's oversight is kind of thin and sketchy. They have 2 hearings a year that they've mandated in law. The Fed has to come and report on what it's done to the House and the Senate. But those are typically more theater than substance. So there's occasionally some digging into certain issues, but for the most part, they aren't really analytical reviews of the performance of the Fed in recent years, what kind of macroeconomic results they've brought about, what kind of inflation performance they've brought about, what their record on supervision is. I mean, there's hearings about that, but it tends to be it just tends to be more political theater than substance. And I think that's where accountability is kind of weak, and that too leaves them vulnerable. They've cultivated over decades a mystique about the central bank, that it's a technocratic realm of experts and somewhat like wizards. That we know what they're doing. And you might have brought up at the beginning something about the Wizard of Oz.
Yep.
There's kind of a trust the man behind the curtain
Right.
aspect to the way the Fed, but particularly in the 80s and 90s. Under Volcker and Greenspan, that I think has come back to haunt them, because we're in an era now of widespread distrust of technical expertise wielded within political institutions.
And so we will see who out there plays the role of Toto and pulls back the curtain on the Great Wizard.
That's a good question.
Jeffrey Lacker, I appreciate you very much being with us today. We will put in the notes to the show a link to the Shadow Federal Open Market Committee, where people can sign up for the newsletter, which I am looking forward to getting, and seeing how outsiders who are somewhat insiders look at what the Fed does. But Jeffrey Lacker, former president of the Richmond Federal Reserve and a senior affiliated scholar at the Mercatus Center at George Mason University, thank you for joining us today on The Ballot.
My pleasure.
And for everyone else, you can listen to this wherever you get podcasts. You can also watch us on YouTube. And until next time, I'm Norm Leahy. We'll be back soon with a new episode. And until then, we'll see you on the digital pages of Ballotpedia. Take care.